Imagine for a moment you're running a business, maybe looking at your desk, and you're just staring at this mountain of documents. You've got invoices, receipts, contracts, all just piling up.
Oh, I know that feeling. It can be pretty daunting.
Exactly. And your mission, right, is to figure out exactly what tax benefits your business genuinely qualifies for. It could feel less like, finding that needle in a haystack and more like you're trying to navigate a complex maze completely blindfolded. It's tough.
It really is. It's a challenge that so many businesses, big and small, they grapple with this constantly. The sheer volume and just the intricate nature of tax laws can certainly be overwhelming.
Absolutely. And that's precisely why today we're embarking on what I think is a really crucial deep dive. We're looking into one of the most vital, yet, let's be honest, often perplexing aspects of the goods and services tax, or GST, regime. We're talking about input tax credit, commonly known as ITC. Now, this isn't just another dry tax term. It's like the fundamental engine, the powerhouse for the entire GST system. And truly grasping it is absolutely critical for any business that wants to manage its finances effectively.
Indeed it is. Without ITC, the GST system, which is designed, remember, as a value-added tax, it just wouldn't function as intended. It's the core mechanism, really, that stops taxes from just piling up and up at every stage of the supply chain.
Right. So our mission for this deep dive is simple. Cut through all that complexity. We want to extract the most important nuggets of knowledge, arm you, our listener, with some surprising facts, and give you the practical insights you need to be truly well-informed.
Think of this as maybe your shortcut to mastering ITC, designed to give you those aha moments, hopefully without feeling totally overwhelmed by, information overload.
Exactly. We've meticulously compiled insights from the foundational CGST Act and its accompanying rules, mixed in recent statutory updates, and those absolutely crucial clarifications the government issues from time to time. So let's begin. Okay, let's unpack this right from the very beginning then. What exactly is ITC, and why do people often call it, quite dramatically, the lifeline of the GST regime?
That sounds like a pretty big claim for a tax concept.
Well, it's a big claim because its function is just so incredibly foundational. Input tax credit is, in essence, it's a mechanism. It allows businesses to reduce their tax liability. How? By claiming credit for the tax they've already paid on their purchases.
Purchases of what, specifically?
Good question. Purchases of inputs, so raw materials, for example, input services like consultancy or marketing, and capital goods, machinery, equipment, that sort of thing they use in their operations.
Okay, so I buy stuff for my business, I pay GST on it.
Right. And then ITC lets you use that very same GST amount you pay to offset or, reduce the GST you collect from your own customers when you sell your finished goods or services.
Ah. And this is precisely what makes GST a value-added tax system. Tax gets collected at each point in the supply chain, yes. But crucially, businesses are allowed credit for the tax paid at the earlier stages.
So it's essentially ensuring you're not paying tax on tax at every single stage. If I buy something, pay GST, use that to make something new, which I sell and charge GST on, I'm not getting taxed twice on that first purchase.
Exactly. That's the absolute core promise, the brilliance, really, of how GST is supposed to work. Seamless credit flowing across the entire supply chain. It completely eliminates that awful cascading effect of taxes.
Which was a huge issue before GST, right? Made things more expensive.
A major problem in our previous indirect tax system, yes. It led to goods becoming progressively more expensive. The fundamental idea now is that the ultimate tax burden should only fall on the final consumer, not on the businesses who are just facilitating the supply chain.
Okay, that makes sense.
And this seamless flow of credit is what gives ITC its lifeline status. It underpins the entire structure of GST, with, only a few very specific defined exceptions to this principle.
That makes perfect sense. It's like a continuous thread of credit weaving through the whole process, making it way more efficient. But okay, how do you actually get this credit? What are the absolute must-haves, the non-negotiables, the foundational conditions for any business looking to claim this crucial ITC? I imagine it's not quite as simple as just saying, hey, I paid tax, give me my credit.
No, you're absolutely right there. There are quite rigorous conditions, actually, and a registered person must fulfill all of them to be eligible. It's all laid out pretty clearly in the relevant sections of the CGST Act and the rules.
Okay, condition number 1.
The very first condition is possession of a valid tax-paying document. And this isn't just any old piece of paper, right? You need an official document. Typically, that's an invoice, maybe a revised invoice from your supplier, a debit note, perhaps a bill of entry if you're importing goods,
Or something from an ISD, which you mentioned.
or a document from an input service distributor, yes, which we'll definitely dive into a bit later. Now, this document, it must contain specific essential details. Things like the exact amount of tax charge, a clear description, and the value of the goods or services.
The basics.
The basics, plus the GST identification, numbers the GSTNs of both the supplier and you, the recipient. And the place of supply is also crucial, especially for interstate transactions. Bottom line, without a proper, complete document, you get no credit. Step 1, failed.
Right, so it's not enough to just pay the tax. You need the official proof, the paperwork with all the right details. That's step 1. What's next on the checklist?
The second condition, and honestly, this is a really significant one, it often causes headaches for businesses. It's supplier's compliance.
Maybe.
Meaning your supplier must have properly furnished the details of that invoice or debit note in their outward supplies statement.
Right.
It's usually their form, GSTR1, or if they're using it, the invoice furnishing facility, the IFF.
Okay, so they have to report it correctly.
Yeah. Yes, and this is the crucial part. These details must then be communicated to you, the recipient, in your automatically generated form GSTR2B. Now, here's where it gets interesting, or maybe frustrating.
Uh-oh.
If your supplier hasn't done their part, maybe they haven't filed these details correctly, or maybe it just doesn't show up in your GSTR2B for whatever reason, you simply cannot avail the ITC, full stop.
Wow, okay. So I could have a perfectly valid invoice sitting right here in my hand, paid everything, but if my supplier messes up their filing or just doesn't do it, my credit is essentially stuck, frozen?
Pretty much, it puts a huge reliance on the entire supply chain being diligent and compliant. It really emphasizes the need to work with reliable suppliers.
That's a massive responsibility on the recipient then.
Okay.
What's the third condition?
The third is actual receipt of goods or services. You, as the registered business, must have actually received the goods or services you're claiming credit for. Now, that sounds straightforward enough.
But I sense a but coming.
Haha. You sense correctly. Because here's where we encounter some, let's say, fascinating nuances in the law. For instance, there's a very common business scenario called the bill to ship to model.
Bill to ship to, right, where I get the bill, but the goods go somewhere else.
Exactly. In this situation, the goods are delivered to a third party. Let's call them Party C, but this delivery happens based on your direction, Party B. So Party A sends the bill to you, Party B, but ships the goods directly to Party C because you told them to.
Right.
Now, even though you, Party B, don't physically receive those goods at your own premises, the law deems you to have received them for ITC purposes.
Ah, okay, so the legal structure overrides the physical location.
Precisely. A concrete example. Imagine a head office in Mumbai contracts for, say, repairs on computer systems installed at its branch office in Bengaluru. Even though the actual repair services are received by the Bengaluru branch, the head office in Mumbai is deemed to have received them and can avail the ITC, assuming they got the bill. This concept applies equally to both goods and services, by the way.
That's a really crucial distinction. So it's about the legal and commercial reality of the transaction, not just where the truck physically unloads. Okay, what if the goods come in stages, like a big piece of machinery delivered in multiple parts over several weeks? How does that impact when I can claim the ITC?
Great question, and the rule is very clear here. If goods covered under a single invoice are received in lots or installments, you can only take the input tax credit upon receipt of the last lot or installment.
Only the last one, not bit by bit.
No partial credit as you go. For instance, imagine you contract for, say, 10 metric tons of a specialized chemical. The supplier issues the invoice in August for the full amount, but the chemical is delivered in 3 separate installments, with the final truck arriving in November. Even if you paid the whole invoice amount back in August, you can only actually avail the ITC in November once the entire supply is complete. No taking credit before the whole consignment lands.
Got it. No jumping the gun on ITC then. Wait for the final piece. Okay, what's condition number 4?
The fourth condition is that the ITC communication in your form, GFTR2B, must not be restricted by the system.
Restricted by the system. How does that happen?
Well, it means the eligible ITC details, even if reported by the supplier, shouldn't have been automatically flagged or sort of put on hold by the GST system itself. This could happen if there are red flags associated with your supplier. Maybe they're a very new registrant, or perhaps they're known to be defaulting on their tax payments, or maybe there are significant discrepancies showing up between what they've reported and what the system expects.
So the system itself acts like a gatekeeper.
In a way, yes. If your credit related to that supplier is restricted, you simply cannot avail it until those underlying issues are resolved. And that often means you having to chase your supplier to get their compliance in order.
Right. So the system itself can basically put a temporary hold on your credit if it detects potential problems with your supplier. That's a pretty strong incentive for businesses to really vet their suppliers, isn't it?
Okay, what's the fifth condition? The fifth condition gets right to the heart of it. The tax charged on the supply must have been actually paid to the government by the supplier.
Actually paid, not just charged on the invoice, but paid over.
Correct. This payment can be either in cash or through the supplier utilizing their own ITC. Now, this naturally raises a really important and sometimes painful question for businesses. What happens if your supplier collects the GST from you, but then fails to actually pay it to the government?
Yeah. What then? I just out of luck.
Unfortunately, if they don't pay, you, the recipient, may have to reverse the ITC you initially availed based on their invoice. And you might have to pay applicable interest on that reversed amount, too.
Ouch. So I pay the supplier, claim the credit, and they might have to give the credit back plus interest if they don't pay the government.
It can happen, yes. However, there is a relief mechanism built in. You can reavail that reversed credit once the supplier eventually does make the payment. It's designed ultimately to ensure that the tax makes its way to the government's coffers. It emphasizes a sort of collective responsibility within the chain.
So the burden is definitely on the recipient to, well, hope their supplier follows through. And if not, you're potentially on the hook for a reversal, but with the chance to get it back later. That's complex, but clearly crucial. And the final condition. Is there a sixth?
Yes, the sixth and final condition is actually quite simple logistically. You must have furnished your own GST return, specifically Form GSTR3B, to claim the credit. Basically, you can't claim credit if you haven't filed your own return for that period.
Makes sense. You have to file to claim.
Exactly. So this entire framework, all 6 conditions, ensures that credit flows correctly through the system and is properly accounted for. But as we've seen, it also places a significant responsibility on you, the recipient, to ensure your suppliers are compliant and that all these conditions are ticked off. It's truly a chain of trust and, importantly, a chain of compliance that underpins the whole GST ecosystem.
Okay, now, this is where, for me at least, it gets really interesting. We're talking about the situations where even if you've meticulously met all those foundational conditions we just spent time discussing, you might still be out of luck.
Right. The exceptions to the rule.
Exactly. These are what the law calls blocked credits, and they're specifically outlined in Section 17, subsection 5 of the CGST Act. They're explicitly designed to prevent businesses from claiming ITC on certain types of expenses, even if, on the surface, they look like they could be for business purposes. So what's the core principle behind these no-go zones? Why block credit on seemingly business expenses?
That's a great question. The general principle is that while ITC is broadly available for most things used in the course of business, there's a specific, deliberately curated list, a small list in the grand scheme, but important of items where ITC is explicitly disallowed. These blocked credits often relate to expenses that might have a strong element of personal consumption.
Like taking the family out to dinner on the company card.
Potentially, yes. Or things related to luxury or expenses that lead to the formation of immovable property, things that aren't primarily intended for onward taxable supply in the usual course of that business. The idea is to prevent businesses from claiming credit on items that might not directly contribute to that value-added process GST is focused on, or items that are essentially fixed assets rather than things circulating in the supply chain.
Okay, so it's about drawing a line between core business inputs and other types of expenditure. Let's break down some of the most common and probably important categories. Where do we start?
Let's start with a big one. Motor vehicles, vessels, and aircraft, along with services related to them. Now, generally speaking, ITC is blocked on motor vehicles that are used for transporting persons, specifically if they have a seating capacity of not more than 13 persons, and that includes the driver.
So my standard company car for executives, a sedan or an SUV, seating 5 or 6 people, that's likely a blocked credit.
Correct, if it seats 13 or fewer. Vessels and aircraft are also typically blocked for ITC purposes. The law often views these as having, a potential personal use element or perhaps a luxury component, or simply not being directly used for making an onward taxable supply in most typical business scenarios.
Okay, so the default is no for smaller passenger vehicles, but you said generally.
Right.
are there exceptions?
Ah, yes. And here's where it gets surprising, or rather logical, depending on your business. It's all about how the vehicle is actually used. There are clear exceptions where ITC is allowed.
Like what?
Well, if these conveyances, cars, boats, planes, are used for making a further taxable supply of similar vehicles. Think of a car dealership. Buying cars is their core input for resale, so they get ITC.
Makes sense. What else?
Or if they're used for the transportation of passengers as a business, like a taxi service, a bus operator running coaches, or an airline, their business is transporting people, so the vehicle is a core input.
Right, it's fundamental to their service.
Exactly. ITC is also allowed if they're used for imparting training on driving, navigating, or flying. Think driving schools, flight schools. And importantly, ITC is allowed if they're used for the transportation of goods. So a truck used for deliveries, a cargo ship, a cargo plane, these would generally qualify for ITC because they're moving goods in the supply chain.
So the key takeaway here is really, if the vehicle itself is an integral part of your taxable supply chain, or it's the main tool for your primary business activity, it's typically eligible for ITC. Otherwise, probably not.
That sums it up perfectly. Now, what about services related to these vehicles? Things like getting them insured, serviced, repaired, maybe leasing or renting them. Are those also blocked if the vehicle itself is blocked?
Good question. Does the block extend to the associated services?
Yes, it generally does. Services like general insurance, servicing, repair, maintenance, leasing, renting, or hiring of the blocked motor vehicles, vessels, or aircraft we just discussed, those services are also generally blocked for ITC.
Ah, okay. So if the car ITC is blocked, the repair ITC is blocked too.
Typically. However, the exceptions cleverly mirror the exceptions for the conveyances themselves. ITC is allowed on these related services if the conveyances themselves are used for those eligible purposes we just listed, like for resale, passenger transport, training, or goods transport.
Okay, that's consistent.
It is.
Oh,
ITC on these services is also allowed if the services are received by a manufacturer of such conveyances, or if they're received by a general insurance service provider in respect of the vehicles, vessels, or aircraft that they actually insure.
right.
Furthermore, if these services are used for making an outward taxable supply of the same category of services, for example, if you run a car rental company and you lease some cars from another company to then rent out to your customers, you can claim ITC on that lease cost. Or if they're an element of a taxable composite or mixed supply. And very importantly, just like with the vehicles themselves, if it is obligatory for an employer to provide these services, like transport, to employees under any law, then the ITC on those services is allowed.
That's a lot of intricate detail just for vehicles and related services. And I remember hearing there were specific clarifications around demo vehicles used by dealers. That always seems like a gray area. What's the actual deal there?
Yes, you're right. Demo vehicles often cause confusion. There's a specific clarification that helps. ITC on a demo vehicle is not blocked if it's genuinely used for the further supply of such motor vehicles. What that means in practice is using it for promoting sales, like offering test drives to potential customers that ultimately lead to a sale by the manufacturer or dealer.
So if it's a sales tool, it's okay.
Essentially, yes. Here is that the demo car is seen as an input to your eventual outward supply of vehicles. However, if that same demo vehicle is used for purposes other than directly promoting sales, maybe it's used for transporting staff. Or perhaps the dealer is merely acting as an agent and isn't directly involved in the purchase or sale of the vehicle from the manufacturer, then the ITC is blocked.
Okay, purpose matters.
Absolutely. And what's also critical to note is that simply capitalizing the demo vehicle in the dealer's accounting books, treating it as an asset, does not in itself affect whether ITC is available or not. But, and this is a big but, if you, the dealer, claim depreciation on the tax component of that vehicle under income tax law, then ITC on that specific tax component will be disallowed. You can't claim both benefits. No double dipping.
Right, makes sense. ITC or depreciation on the tax part, not both. That's a very practical distinction for dealers. And wasn't there also a recent clarification about ex-works contracts, something effective later this year?
Yes, that's correct. A welcome clarification for goods delivered under an ex-works or EXW contract. This becomes effective from November 1st, 2024. It's particularly relevant for international trade, but applies domestically too.
So what's the change?
Under this clarification, ITC can now be availed at the time the supplier hands over the goods to the transporter at their factory gate. This act is now deemed to be receipt by the recipient for ITC purposes.
Ah, so I don't have to wait until it physically arrives at my warehouse.
Exactly. It simplifies things significantly for buyers, especially importers, who might not physically receive the goods immediately at their own premises. It aligns the ITC claim point with the transfer of risk under EXW terms. However, there's a crucial caveat. If those goods, after this deemed receipt at the factory gate, are later diverted for non-business purposes, or maybe they get lost or stolen or destroyed before reaching you or being used in your business,
And what?
then the ITC you claimed based on that deemed receipt will be disallowed at that point. The system still expects the goods to eventually be used for taxable business purposes.
Okay, so it's a timing advantage, but the end-use condition still applies. That's a practical and logical clarification.
Okay.
Right, let's move on. What's the next major category of blocked credits? I see things like food and beverages, outdoor catering, beauty treatment, health services, cosmetic and plastic surgery, life insurance, and health insurance. These definitely sound like things that could blur the lines between business and personal expenses.
Exactly. And that's generally why they are on the blocked list. These services are typically blocked for ITC. Additionally, things like membership of a club, health and fitness centers, and travel benefits extended to employees when they're on vacation, like leave travel concession, LTC, or home travel concession, those are also blocked.
So, gym memberships for staff are out.
Generally, yes. The underlying logic here is pretty similar to the vehicles. These items or services often have a significant personal consumption element, and it's usually difficult to argue convincingly that they are purely and solely for business purposes.
But again, are there exceptions? Because sometimes these things are business expenses, aren't they?
Yes, and once again, the exceptions are quite important. ITC is allowed on these otherwise blocked items if the services are used by a registered person for making an outward taxable supply of the same category of goods or services.
The caterer hiring another caterer example.
Precisely. If you're a caterer and you subcontract another caterer to help fulfill a large wedding order, you can claim ITC on the services you procured from the subcontractor because it's a direct input to your own taxable catering output.
Okay, what else?
Or if these services are an element of a taxable composite or mixed supply. And just like we saw with vehicles and the related services, if it is obligatory for an employer to provide these benefits to employees under any law, for instance, mandatory canteen facilities required in certain factories or health insurance that might be legally mandated under labor laws, then ITC is allowed.
So legal obligation overrides the general block.
Yes. So, to contrast, a manufacturing company buying food to provide free lunches to its visiting customers would likely find the ITC blocked. But if AB & Co., a caterer, subcontracts the snack preparation to CD & Sons for a marriage event they are managing, AB & Co. can claim ITC on those subcontracted catering services. It's all about whether it's an input to your output or legally required.
That provides some really helpful clarity. So if it's a core input to your business output or it's legally mandated, ITC is generally fine. Otherwise, for these personal consumption-prone categories, it's typically blocked.
Okay, what about works contract services? That seems like a massive one for any business that's constructing or renovating property.
Indeed, this is an absolute crucial area and often complex. The rule is, works contract services supplied for the construction of immovable property other than plant and machinery are blocked.
Okay, let's break that down. Works contract means construction, building, repairs involving both goods and services, right?
Yes, essentially. And immovable property is land, buildings, structures fixed to the earth. So this means if you're building, say, a new office building or a shopping mall or a warehouse, the ITC on those construction services, the labor, the materials that become part of the building itself, that ITC is generally not allowed.
Right, because the building itself isn't usually sold onwards in the same way goods are. Exactly. But the exceptions here are vital. ITC is allowed where the works contract service is an input service for the further supply of works contract service.
The subcontractor point again.
Yes, the classic subcontractor scenario. If you are a main works contractor yourself and you subcontract part of the building work to another specialized contractor, you can claim ITC on that subcontracted service because it's an input cost for your own taxable works contract output that you'll bill to the final client.
Okay, that makes sense. Any other exceptions?
Yes, it's also allowed for the construction of eligible plant and machinery, even if that plant machinery is capitalized in your accounting books. So if the works contract is specifically for installing or constructing something that qualifies as plant and machinery, the ITC is available.
Now, wait. Here's where I think it gets really interesting. I remember reading something about this. The definition of construction for this specific purpose, for blocking credit, is quite specific, isn't it? It includes things like reconstruction, renovation, additions, alterations, or repairs, but only to the extent they are capitalized in the books of account.
You've hit on a crucial point. That's exactly right. So if you incur an expense for, say, repairing your office building, and that repair expense is not capitalized, maybe it's a routine repair, and you just debit it directly to your profit and loss account as a regular revenue expense, then the ITC on that works contract service is allowed. This applies even if the repair is for a building, not just plant and machinery.
That is a huge distinction. That could unlock significant ITC for businesses on regular repair and maintenance costs that aren't major capital projects. That's a massive aha moment right there.
Absolutely. That capitalization aspect is the key differentiator between capital expenditure, where ITC might be blocked for immovable property other than P&M, and revenue expenditure, where ITC on works contract services for repairs is generally allowed for ITC purposes here. It's vital to get the accounting treatment right.
Okay, so we need to be clear on what plant and machinery actually means in this context, because that's the big exception for construction ITC. Is there a specific legal definition?
Yes, the law provides a specific definition for this purpose. Plant and machinery includes apparatus, equipment, and machinery that are felt to the earth by foundation or structural supports and are used for making outward supply of goods or services, or both.
So the machinery in a factory, bolted to the floor, used to make products.
That would typically qualify, yes. But crucially, the definition explicitly excludes certain things. It excludes land, buildings, or any other civil structures. It also excludes telecommunication towers and pipelines laid outside the factory premises.
So a structure that is primarily just a building doesn't count as plant and machinery, even if it houses machinery. But a specific machine fixed into the ground does count. Okay.
That's the general idea.
There's
However,
always a however.
well, if we connect this to the bigger picture, the Supreme Court has actually weighed in on this distinction in a very interesting way. They looked at the wording. The explanation section defining plant and machinery uses that exact phrase, plant and machinery. But the blocking section, section 17.5, refers to construction of immovable property other than plant or machinery.
Subtle difference. And versus or, does that matter?
The Supreme Court suggested it might. They observed that the subtle difference could suggest the legislature intended a slightly broader meaning for plant or machinery in the blocking clause. The court proposed, quite insightfully, that plant or machinery could potentially even include certain buildings if those buildings function as a plant for the business,
Like how?
like perhaps a shopping mall or a large automated warehouse. The court suggested that if the building structure and function are so integral to the specific business activity or service supply happening within it, it might be considered a plant based on its functional utility, not just its physical form as a building.
Wow, that functional approach is quite progressive. It focuses on what the structure does for the business, not just what it is. That could definitely broaden the scope for ITC in certain business models, like retail or logistics.
It's certainly a very interesting line of reasoning from the highest court, yes. And speaking of specific structures, there was also a very practical clarification issued regarding ducts and manholes used in optical fiber cable networks, right?
Yes, for telecom companies. Are those blocked or allowed?
They are not restricted. The clarification states that ITC for ducts and manholes used in optical fiber cable OFC networks for telecommunication services is available. The reasoning is that these are considered basic, integral components of the OFC network itself and are therefore covered under the definition of plant and machinery, as they are directly used for making the outward supply of telecommunication signals. They aren't seen as standalone civil structures, nor are they telecom towers or pipelines outside factory premises, which are excluded.
Okay, good news for the telecom sector then. Now next on the blocked list, goods or services received for the self-construction of immovable property. Does that mean if I decide to build my own office building using my own resources or hiring contractors directly, specifically for my business use, I generally can't claim ITC on the materials and services used?
Generally, yes, that's correct. If you, as a taxable person, receive goods or services for the construction of an immovable property again, the crucial exception is other than eligible plant or machinery, and you are building it on your own account, meaning for yourself, not as a contractor for someone else. Even if it's entirely for your business purposes, the ITC is blocked.
So if I'm building my own corporate headquarters, even though it's 100% for business, I typically cannot claim ITC on the bricks, the cement, the steel, the architect's fees, unless that specific cost relates directly to the installation of qualifying plant or machinery that will go inside the building.
That's the general rule, yes. The exceptions are, as you noted, when it's specifically for eligible plant or machinery, or when the value of the goods services is not capitalized, like those repairs we discussed, or, importantly, when the construction is not on your own account, i.e., if you are a developer or contractor building the property for another person to sell or use.
Okay, clear enough. What about inward supplies, where the tax has been paid under the composition levy? If I buy something from a small dealer who is under the composition scheme.
That's a straightforward one. ITC is completely disallowed on goods or services on which tax has been paid under the composition scheme, Section 10.
And why is that?
The reason is quite simple. Businesses registered under the composition scheme cannot legally charge GST to their customers. They pay tax at a flat rate on their turnover directly to the government. Since they don't charge GST on their invoices, and thus don't issue proper tax invoices showing GST, there's simply no tax for the recipient, like you, to claim as credit. No tax charged means no credit can be passed on.
Got it. No tax on the invoice, no ITC. Makes sense.
Yeah.
And what about for non-resident taxable persons, NRTPs, people or companies registered temporarily from abroad?
For inward supplies received by a non-resident taxable person, NRTP, the general rule is that ITC is blocked for goods or services they receive in India.
So if a foreign company sets up a temporary project office here, they can't claim ITC on local purchases.
Generally not on local purchases of goods or services. However, there's one very important exception. An NRTP can claim ITC on goods imported by them, so if that foreign entity temporarily registers in India and imports goods for their project, they can claim the IGST paid on those imports as ITC, but not typically on services procured locally or goods bought locally.
Okay, an exception just for imported goods for NRTPs. Now, here's one you flagged as relatively new and quite significant, especially for larger companies. It's effective from November 1st, 2024, corporate social responsibility CSR activities. This sounds like it could impact quite a few businesses.
It absolutely could. This is a very important recent change that companies with mandatory CSR obligations under Section 135 of the Companies Act 2013 really need to be aware of. The new rule explicitly states that ITC is now blocked on goods or services used for activities related to fulfilling these mandatory CSR applications.
So wait, if my company spends money on CSR, which is legally required for us, maybe we distribute educational kits to underprivileged children or build sanitation facilities in a village. Even though it's a mandated expense, we cannot claim ITC on the GST paid for the goods or services used for that.
That is precisely what the change means, yes. Even if it's for a universally good cause, and even if it's legally mandated under the Companies Act, if the expenditure is incurred to meet your Section 135 CSR obligation, you cannot claim ITC on it.
Wow. Let's take an example. Say ABC Manufacturing PVT Ltd. distributes 1,000 educational kits to a rural school as part of its required CSR spend. Let's say they paid $50,000 ITT on buying those kits. That euro 50,000 cannot be claimed as ITC anymore.
Correct. Under the new rules effective, November 1, 2024, that euro 50,000 ITC would be blocked because the expense was for fulfilling their CSR obligation. It's a significant shift in the tax treatment of CSR spending.
That really is a big shift. It changes the net cost of CSR for companies significantly.
Okay, moving on. Then there's the obvious one, I suppose, personal consumption. Yes, goods or services used for personal consumption are, as you'd expect, straightforwardly blocked. This is a clear and simple restriction for any non-business use. The entire ITC system is designed for business-to-business credit flow related to taxable supplies, not for subsidizing personal expenses.
Right. That one's a given. Now, what about things that happen in business sometimes? Goods that are lost, stolen, destroyed, or written off? Or items given away as gifts or free samples. That seems like a fairly common set of occurrences that could potentially impact ITC claims.
Indeed, they are common, and yes, they do impact ITC. The rule here is that ITC is blocked on goods that are lost. For example, in transit or storage, stolen, destroyed, example by fire or flood, or becoming obsolete, written off from the books, or disposed of by way of gift or free samples.
And the logic here is...
The logic is typically that because no tax is payable on their outward supply, you're not selling these lost or destroyed goods or charging for the gift samples, the input credit related to them should be disallowed. The principle is, if you're not making a taxable outward supply using those inputs, you shouldn't get credit for the tax paid on those inputs. No output tax, no input credit.
Okay. But businesses use promotional schemes all the time.
Yeah.
There must be specific clarifications around common things like free samples or buy one, get one free offers, right? How do those fit in?
Absolutely. And these clarifications are very important for you, the listener, as these scenarios can be quite confusing. Let's break them down. First, samples and free gifts, provided completely without any consideration. Generally, ITC is not available on the inputs used to make or procure these freebies. Why? Because if there's no consideration charged and it doesn't fall under specific deemed supply categories in the law, like certain transactions with related parties, it's not considered an outward supply under GST at all. And as we just said, no outward supply generally means no input credit.
Okay, so truly, free samples are usually ITC negative. What about buy one, get one free BOGO offers? That feels different because the customer's paying something.
It is treated differently. For BOGO or similar offers, ITC is available to the supplier on the inputs for both items. The law doesn't treat the free item as a separate zero-value supply. Instead, it views the whole deal as a single composite supply of two goods for one consolidated price. Since it's still a taxable outward supply made by you for a consideration, the inputs used for both items remain eligible for ITC.
That's a relief for retailers. So BOGO is okay for ITC. What about discounts, like volume discounts given later or post-supply discounts? Does that affect the supplier's original ITC?
Generally, no. For discounts, whether they are staggered or agreed upon and given after the post-supply discounts, the supplier's original ITC on the inputs used to make that supply is generally still available, provided the discount meets the specific conditions laid out in the GST valuation rules, like being linked to the original invoice. Even if the recipient might have to reverse some of their ITC corresponding to the discounted amount because they effectively paid less tax, the supplier usually gets to keep their ITC on the original inputs.
Okay, that's good to know. And you mentioned a very practical point earlier about time-expired goods being returned. How does ITC work there, especially if the manufacturer then has to destroy them?
Yes, this is a very practical scenario, especially in industries like pharma or FMCG. The clarification is this. If a registered person, like a retailer or distributor, returns time-expired goods back to the manufacturer, and they do this by treating it as a fresh supply, meaning they issue a proper tax invoice to the manufacturer for the return, then the manufacturer can avail ITC on this return supply based on that invoice.
Okay, so the return itself generates ITC for the manufacturer.
Yes. However, if these return goods are then destroyed by the manufacturer, which is likely as they're expired, the manufacturer must then reverse the ITC they availed specifically on that return supply. Crucially, they reverse the ITC claimed on the return, not the ITC they originally claimed when they first manufactured the goods months or years earlier.
So let's use your earlier example. If the original manufacturing ITC was 10 per unit, maybe due to price changes, the ITC on the return supply invoice from the retailer was 15 per unit. If the manufacturer destroys that returned unit, they have to reverse 15, not the original 10.
Exactly that. You reverse the ITC corresponding to the immediate previous transaction, which was the return supply. It's a crucial distinction about which ITC gets reversed upon destruction.
That's a very clear and important operational point. Okay, and finally, under blocked credits, what about tax paid in fraud cases or for detention or confiscation of goods? Hasn't there been a recent change here too?
Yes, this is the last category listed under blocked credits in Section 17.5, and there has indeed been a very significant recent amendment here, effective November 1st, 2024. Historically, this clause blocked ITC on tax paid under Section 74, which deals with tax demands raised due to fraud, willful misstatement, or suppression of facts, and also tax paid under Sections 129, detention of goods conveyances in transit, and 130, confiscation of goods.
Okay, so paying tax under those penalty sections meant you couldn't use that payment as ITC. What's changed?
If we connect this to the bigger picture, this is a really important development. The amendment clarifies two things. First, the blocking of ITC for tax paid due to fraud under Section 74 is now specified to apply only for periods up to the financial year 2023-24.
Implying it might not be blocked for future periods. Or is that unclear?
The implication is that for FY 2024-25 onwards, even tax paid under Section 74 might potentially not be blocked from being claimed as ITC, although we might need further clarification on the interplay with other rules. But the really clear change is this. The references to Sections 129, detention, and 130, confiscation, have been completely removed from the blocked credit list in Section 17.5 for financial year 2024-25 onwards.
Wow. So paying tax related to goods being detained in transit or confiscated might not automatically block that amount from being claimed as ITC in the future.
That's what the removal strongly indicates, yes. It signals a significant policy shift. Perhaps the thinking is to handle those situations through penalties and fines rather than also imposing an ITC blockage. It might be linked to other changes in how these sections operate. It's a very important recent development to watch.
That is a pretty substantial change, especially removing the block related to detention and confiscation for future financial years. It could significantly change the financial impact of such incidents.
Okay, one last clarification. Under blocked credits, insurance companies and motor vehicle repairs, specifically when they reimburse claims rather than paying the garage directly. How does ITC work for them? It seems like a unique situation.
Yes, it's a common scenario, and there's a specific clarification that resolves a long-standing question. The clarification states that ITC is available to general insurance companies for the motor vehicle repair expenses they incur, even when it's done under the reimbursement mode of claim settlement.
Even if the policyholder paid the garage first and then got reimbursed.
Yes, provided certain conditions are met. The key is usually that the invoices from the repairer should ideally be issued, at least partially or fully, in the name of the insurance company. And the insurance company must claim ITC only for the amount that they actually reimbursed to the policyholder or paid to the garage. So why is the insurance company eligible? They didn't technically receive the repair service directly.
The reasoning is that even though the policyholder might make the initial payment or interact with the garage, the insurance company is considered the ultimate recipient of the repair service to the extent of the approved claim amount. Why? Because that repair service is an essential input for them to fulfill their contractual obligation under the insurance policy, which is their outward supply of insurance services. So if a garage issues, say, 2 invoices, one to the insurance company for the approved amount and one to the customer for any deductible or non-covered part, the insurance company can avail ITC only on the invoice addressed to it. If it's a single invoice in the customer's name but paid partly by insurance, the insurance company can generally avail ITC on the portion they paid, provided they have the necessary documentation linking their payment to that invoice. But if the invoice isn't in the insurance company's name at all, or they can't link their payment, then typically no ITC is available to them.
All right, so we've covered the day-to-day rules for getting ITC, and importantly, all those specific no-go zones or blocked credits. But what happens when your business situation fundamentally changes? You know, those big life events for a business, like what if you just got registered for GST for the first time? Or maybe you're switching out of that simpler composition scheme into the regular tax scheme. Or what if a product you sell used to be exempt from GST, but suddenly becomes taxable? How does ITC work then? I imagine the law must have special provisions for these kinds of transitions, right? Section 18, I believe?
You're absolutely right. Section 18 of the CGST Act deals specifically with these special circumstances. It's designed to ensure that businesses can manage their input tax credits smoothly even when they go through these major transitions, preventing either undue hardship or, conversely, undue benefit. It aims for fairness during change. Let's look at the specific scenarios where you become entitled to claim ITC under these special circumstances.
Okay, where do we start? Becoming newly registered.
Exactly. First scenario, becoming liable for registration. Let's say your business turnover crosses the GST registration threshold. If you apply for registration within 30 days from the date you actually became liable, and your registration is subsequently granted, you are entitled to take input tax credit.
Credit on what, though? Stuff I bought before I was registered.
Yes, specifically, credit on all the inputs that you hold in stock on the day immediately preceding the date on which you became liable for registration. This also includes inputs that are contained within your semi-finished or finished goods that are also in stock on that day.
So basically, the inventory I have on hand the day before I needed to be registered.
Correct. But here's a key point for this specific scenario. You get no ITC on capital goods you might have bought before registration. The entitlement here is focused purely on your stock of inputs and goods containing inputs.
Okay, inputs and stock covered. But capital goods are left out when you first become mandatorily registered. What if I register voluntarily before I even cross the threshold? Do I still get ITC on my stock?
Yes, you do. That's the second scenario. Voluntary registration. Even if you haven't crossed the threshold but decide to register for GST voluntarily, maybe to allow your B2B customers to claim ITC, you are still entitled to ITC on the inputs held in stock, including those in semi-finished or finished goods. The crucial date here is the day immediately preceding the date your voluntary registration is actually granted by the authorities.
And again, just the stock. No capital goods in this case either.
Correct. Just like mandatory registration under voluntary registration too, there's no ITC entitlement under Section 18 for capital goods purchased prior to the registration date. It's really about bringing your existing inventory into the GST credit chain when you join the system.
Okay, that's a really important distinction.
Yeah.
Inputs in stock are covered when you first get registered, mandatorily or voluntarily. But capital goods bought beforehand are generally not brought into the credit chain at that point under Section 18. Now, what if you're already registered but you're changing your tax scheme? For instance, moving out of that simpler composition scheme and becoming a regular taxpayer who charges full GST.
That's our third scenario under Section 18, and here things change regarding capital goods. This is about exiting the composition scheme. If you cease to pay tax under the composition scheme, Section 10, and transition to becoming a regular taxpayer under Section 9, you are then entitled to claim ITC.
On what? Still just stock.
No, here it's broader. You get ITC on inputs held in stock, including those in semi-finished or finished goods, and significantly, you also get ITC on capital goods that you hold on the day immediately preceding the date you become liable to pay tax under the regular scheme.
So capital goods are included when you switch from composition to regular. That's a big difference. Is it the full ITC on those capital goods?
Not quite the full amount. For the capital goods, there's a specific adjustment you need to make. The eligible credit is reduced. It's reduced by a certain percentage, typically cited as 5% for every quarter, or even part of a quarter, that is elapsed from the original invoice date of that capital good.
Why the reduction?
It's to account for the period the asset was used while you were under the composition scheme. During that time, you weren't eligible for ITC and weren't charging output tax in the same way. So the reduction effectively prorates the credit for the remaining useful life of the asset under the regular scheme.
Okay, that seems fair. It recognizes the prior usage under a different regime.
Yeah.
What's the fourth scenario? You mentioned exempt supplies becoming taxable.
Yes, that's the fourth key situation. When an exempt supply becomes taxable. Imagine you were manufacturing or supplying certain goods or services that were specifically exempt from GST under a notification. Then, let's say the government removes that exemption and your supply suddenly becomes taxable.
Okay, so now I have to charge GST on something I didn't before.
Exactly. In this situation, you become entitled to claim ITC. You can take credit on the inputs held in stock that are directly relatable to that now taxable supply. And similar to exiting the composition scheme, you also get ITC on capital goods that were being exclusively used for making that previously exempt supply. The entitlement applies from the day immediately preceding the date the supply becomes taxable.
And is there a similar reduction for the capital goods here too?
Yes, same principle applies. For these capital goods that were used exclusively for the exempt supply, the ITC available is reduced by that same 5% per quarter, or part thereof, from the original invoice date, accounting for the time they were used for non-taxable purposes. It's all about aligning the input credit with the generation of taxable output.
So to summarize those entitlement scenarios, joining GST, mandatory voluntary, gets you ITC on stock. Switching from composition or exempt to regular taxable gets you ITC on stock and a pro rata ITC on relevant capital goods. That's a helpful framework. Now, what about the flip side? When do you have to give back or reverse ITC that you might have already claimed under the regular rules?
ITC reversal under Section 18.4 is indeed required in a few key situations, essentially the mirror image of becoming entitled.
Such as?
Well, if you switch from the regular scheme, where you were availing ITC, to the composition levy, you must reverse the ITC you hold in relation to your inputs in stock, including in semi-finished goods, and also on your capital goods.
Okay, switching into composition triggers reversal. What else?
Similarly, if a taxable supply of goods or services you currently make suddenly becomes wholly exempt by notification, you'll need to reverse the ITC attributable to the inputs in stock related to that supply, and also the pro rata credit on capital goods used for it. And of course, upon the cancellation of your GST registration, you generally need to reverse the ITC associated with any stock and capital goods you hold at that time.
So if you're leaving the regular GST system in some way, you generally have to pay back the credit on assets still held. How is this reversal actually calculated, especially for capital goods? It sounds tricky.
The specific manner of calculating this reversal is detailed in the rules, specifically Rule 44. For inputs held in stock or contained in goods, the ITC amount to be reversed is calculated proportionately based on the corresponding purchase invoices. If, for some reason, the original invoices aren't available, the value of those goods has to be estimated based on the prevailing market price at the time of the switch or cancellation. This market value might need to be certified by a chartered accountant or a cost accountant if the tax authorities require it.
Okay, that's for stock. What about the capital goods reversal calculation? You mentioned remaining useful life.
Yes, for capital goods, the reversal is based on the ITC involved in their remaining useful life. The law generally considers the total useful life of capital goods for this purpose to be 5 years, or 60 months, from the date of invoice. You calculate how many months are left in that 60-month period from the date you need to reverse the credit. The reversal amount is then computed on a pro rata basis for those remaining months. It's basically ensuring you only effectively retain the credit for the period you actually use the asset while making taxable supplies under the regular scheme.
That makes sense conceptually.
Yeah.
Calculate the unused portion of the 5-year life and reverse the corresponding ITC. Now, what about when the business itself changes form? Like a merger where Company A merges into Company B, or maybe a demerger where one part of a company splits off. Can the input tax credit sitting in Company A's account be transferred to Company B or the new entity? That seems like it could be a massive logistical challenge, moving potentially large credit balances.
Yes, absolutely. And the law specifically provides for this under Section 18.3 and Rules 41 and 41A. These cover the transfer of ITC when the business constitution changes.
How does it work in a straightforward case, like a full merger or sale of the business?
For a general transfer situations like a sale of the business as a going concern, a merger, an amalgamation, or even a lease or transfer of the business, any unutilized ITC balance that's just sitting there in the electronic credit ledger of the old entity, the transfer, can be transferred to the new entity, the transferee.
Is it automatic?
Not quite automatic, there's a process. The crucial condition is that there must be specific legal provisions within the business change arrangement, like the merger scheme or sale agreement, for the transfer of liabilities as well. If liabilities are transferring, the corresponding assets, including the ITC, can transfer too. To execute this, the transferring entity needs to electronically file a specific form, Form GST ITC-02, on the GST portal. And importantly, this form must be accompanied by a certificate from a practicing chartered accountant or cost accountant.
What does the certificate confirm?
It confirms that the sale, merger, demerger, lease, or transfer has been done along with the specific provision for the transfer of liabilities. Once the transfer files this, the new entity, the transferee, then has to log in and formally accept these details on the portal. Upon acceptance, the unutilized ITC gets seamlessly transferred from the transfers ledger to the transferee's ledger.
Nice. Okay, so a defined process with checks and balances for a full transfer. Now, what's fascinating here, I think, is what happens in a demerger or other partial business transfers, where maybe only one division or unit of a company is spun off or sold. You can't just transfer all the ITC then, surely. How is it split?
You're right. It's not an all-or-nothing transfer in those cases. For demergers or other similar arrangements where only a part of the business is transferred, the unutilized ITC is apportioned. It's divided between the old entity and the new entity, or the partially transferred business.
And how is that apportionment done? What's the basis?
The basis for apportionment is the ratio of the value of assets of the new units, or the partially transferred business, compared to the total assets of the original entity immediately before the demerger or transfer. This calculation is done at the state level.
The ratio of the value of assets, does that mean only assets on which ITC was claimed, or all assets?
That's a key detail. Value of assets here means the value of all assets of the business, regardless of whether ITC was originally availed on them or not. So you look at the total book value of assets being transferred versus the total book value of assets remaining. Let's take a simple example. Company A undergoes a demerger. It transfers assets constituting, say, 60% of its total asset value to a new company, B. In this case, 60% of Company A's total unutilized ITC balance in that specific state would be proportionally transferred to Company B.
Okay, so it's a straightforward pro rata split based on total asset values at the time of the split. That seems like a fair and objective way to divide the credit in complex restructuring.
Exactly. It's designed to be a pragmatic and equitable approach. And there's one more related scenario covered by Rule 41A. This is for companies that obtain separate registrations for multiple places of business within the same state or union territory.
Like a large retail chain, deciding to register each major store separately within, say, Maharashtra, instead of having just one registration for the whole state.
Precisely that kind of situation, maybe for better administrative control or accounting. In such cases, the originally registered entity can transfer its unutilized ITC balance, either wholly or partly, to the newly registered places of business within that same state.
And how is that transfer calculated? Same asset ratio.
Yes, the transfer is again done in the ratio of the value of assets held by the newly registered units at the time they obtain their separate registration compared to the total assets. This requires filing a specific form, Form GST ITC 02A, by the transferor. This allows businesses internal flexibility in managing their credits when they opt for multiple registrations within a single state.
So these special provisions under Section 18 and the related rules really do seem to cover almost any major business life event or structural change, ensuring the ITC system can adapt along with the entity itself. That's absolutely vital for business continuity and fair tax treatment during transitions. Okay, let's shift gears a bit. For businesses that aren't just a single unit, but have multiple branches, offices, factories, maybe spread across the country, or even just a central head office managing things, managing the input tax credit on shared services can get really complicated. But the GST law has a specific mechanism for this, doesn't it? The Input Service Distributor, or ISD. This sounds like it could be a real game changer for streamlining a potentially messy process.
You're absolutely right. The ISD mechanism is, I think, truly one of the elegant solutions within GST for multi-locational businesses. What's really fascinating here is how it effectively centralizes the whole process of claiming and then distributing ITC specifically for common input services.
Common input services, like what exactly?
Right. Think about services that are typically procured or invoiced at a central location, like a head office, but are actually used or consumed by multiple units or branches of the same company across different locations. Good examples would be nationwide advertising campaigns, maybe the annual statutory audit fees for the entire company, centralized IT support services, or perhaps security services for multiple premises under one contract.
Right, things billed to HPU but benefiting everyone.
Exactly. Before ISD, figuring out how to allocate the credit for that single invoice across potentially dozens of branches, each with its own GST registration, would have been a logistical nightmare. The ISD mechanism makes compliance much smoother and more efficient. It ensures that the tax credit associated with these common services actually reaches the right place, the unit that ultimately utilized the service, where it can then be used against their local output tax liabilities, rather than just getting stuck and potentially going unused at the central office.
So the head office, or whichever office gets registered as the ISD, effectively acts as a kind of central clearinghouse. It receives the invoices for these shared services, claims the ITC centrally, and then systematically distributes that credit out to the relevant units that benefited.
Precisely that. An ISD is typically an office, often the head office, but it could be another designated office that receives the tax invoices specifically for input services. Remember, this is only for services, not goods or capital goods, and these services must be used commonly by multiple units or branches of the same legal entity. That means they must all share the same permanent account number, or PAN, even if they have different GSTAN because they are in different states or registered separately.
Okay, same company legally, just different locations or registrations.
Yes. The ISD's sole role, then, is to correctly distribute the ITC related to these shared services among its various units or branches. And it's really important to emphasize this point. An ISD is compulsorily required to obtain a separate, distinct registration specifically as an ISD. This is mandatory, regardless of whether that office already has another GST registration, like a regular taxpayer registration.
So it's not optional. If you're going to distribute input service credit like this, you must get a separate ISD registration. There's no turnover threshold or anything.
No threshold.